Bryan Whalen manages the $5.3 billion fund, and he's also the co-head of the mortgage-backed securities division at TCW Investment Management. He joins us now from our Los Angeles bureau. Bryan, thank you so much for joining us. Appreciate it.
Thanks for having me.
So talk to us a little bit about the makeup of your fund. I mean, obviously, when you're talking bonds, it's a pretty big umbrella. So what's the sort of allocation of what type of bonds you guys are invested in?
Well, it's a unique fund. Most funds out there, what you'd call traditional core plus funds, and that they invest in corporate bonds and U.S. Treasuries and mortgage bonds. And what makes this fund unique is that it's really just a sector fund. The majority of the investments in the fund are concentrated in the mortgage-backed securities area, and that includes both mortgage-backed securities that are guaranteed by Fannie, Freddie, or Ginnie Mae, as well as the non-agency mortgages, which have obviously gone through quite an upheaval over the last 2 years.
And so how have those non-agency mortgages been performing? I mean, you would think that it would still be somewhat of a risky investment.
Well, risk all depends on the dollar price you're investing in, and the fund's done a good job of avoiding them early on in the cycle. And in late 2008, early 2009, really ramped up the exposure. And coming into the spring of 2009, had about a 50% exposure to that sector. And since that point in time, the sector is appreciated by about 30% in price. We still think it's one of the cheapest risk-adjusted asset classes out there in the market. It provides both a high current yield to our clients as well as future price appreciation, at least potential price appreciation in our minds.
And do you think that sort of the worst has passed for that group? I mean, we are talking about the lower quality mortgages here that these bonds are based upon. Do you think, I mean, there's still a lot of concern about the housing market, but do you think the worst has passed for that lowest tranche of borrowers?
I think the worst has passed, definitely for the securities market. I think the worst is behind us for the housing market as well. That doesn't necessarily mean we're not going to continue to slide down here over the next 12 months in housing prices. But again, it comes back to the dollar price you're buying these securities out, and it comes down to basically the assumptions that are already built into these prices. And even at today's levels, these bonds could still return a positive yield to clients, even if we slip into a double-dip recession or even a depression.
You know, Bryan, what do you expect to happen sort of for the rest of the mortgage market then? Because still, you know, the majority of your fund is in the agency mortgages. Is there still going to be pain on that side?
Well, there is some pain being felt right now. Prepayments, obviously, at the level of interest rates right now have spiked up dramatically. However, the majority of that pain is actually is actually occurring at the New York Fed and the Treasury, who holds the types of agency mortgages that are incurring the highest prepayments right now.
And how
however, there's...
Bryan, I was just going to
say...
You go first.
Go ahead. What I was going to say was that what's unique about this point in time in the cycle versus previous refinancing cycles is that borrowers don't have the optionality they used to have to refinance, and that they have far less equity in their homes, possibly even no equity or negative equity. And what that means is no matter where interest rates are compared to what they're paying on their mortgage, they don't qualify for a refinancing.
Well, and I guess then the question I was going to ask is, how concerned are you? There's been a lot of speculation in the market that the administration is going to come in and offer some sort of structure so that those folks can refinance regardless. Is that a big concern for you?
I think it's a little pie in the sky. You know, when we look at that type of scenario, what we're really talking about is a transfer of wealth. You're transferring money from mortgage-backed security holders into consumer pocketbooks. The problem with that is that a large majority of the mortgage-backed securities market is actually indirectly held by the taxpayer. So that's going to greatly reduce any of that benefit. And then there are repercussions to going forward with that. Repercussions which are the convexity costs, so the price at which mortgage-backed security holder investors will require is going to go down. They're going to require higher yields. It's going to hurt bank balance sheets. It's going to hurt sovereign wealth funds, non-U.S. entities, which the U.S. Treasury is relying on to buy Treasury bonds to finance our deficit. So it may sound like a good idea on the surface, but when you get down into the weeds, it's not a good idea.
Hey, Bryan, finally, I just want to ask you, I know it's a little bit of a dicey question, but, you know, we talked about the strong 5-year performance of the fund, and there was a management change at the fund that was sort of accompanied by a lot of fireworks. The departure of Jeff Gunlock from TCW, who headed the fund. So with him not at the helm of the fund anymore, how do you keep up that same level of performance?
Well, there's a reason TCW purchased Metropolitan West and our management team to come in, and that we're one of the few teams out there with the experience in mortgages to continue that excellent track record. And I'll point to the track record for 2010, which has been excellent. We're very forthcoming and open with our strategies, and the performance dictates that, and so does the reaction of our clients.
All right, Bryan, I appreciate your time. Bryan Whalen of TCW, thanks a lot for joining us.